the capital requirement will depend on the risk profile of that bank. And it is for the banks to prepare a ICAP document, what we call that capital adequacy assessment process, integrated capital adequacy process, by which they will assess what is their risk. And the risk is on different parameters. And they have to arrive at their own capital requirement. There will be some minimum capital which will be required, and beyond that, it is the banks which have to assess their own capital requirement. And what we will do in our regulation is we will check whether their ICAP document or their own assessment of the risk is good or not good. If we find that they have underestimated their risk, we will ask them to have higher capital. So when the change comes here, I think this question will be well answered, whether the present regulation and capital adequacy norms are adequate to protect the Indian banks. Now again, the banking system, when we talk about the banking system, individual banks will matter. The strength of the chain is the weakest link. So individual banks will be assessed, and the capital adequacy or risk regulation will be dependent on their own risk management structure or effectiveness. So that for the first thing, how to mitigate the procyclicality tendencies in capital adequacy. This is a part of our regulatory framework which has been changed. Basel II, as we call it. This is already included in that. And 3 years back, when we thought that the cycle is going up, we had asked the banks to make adequate provision in anticipation of something going wrong in future, what is called as the provisioning on standard assets, where things have not gone wrong. And in the days to come, that provision is what is going to come very handy to the banks. So I think this has been already answered. Deposit insurance, whether it is robust enough. Deposit insurance is again for the depositor's benefit, not for the benefit of the system. As I told you in the beginning, we are interested in depositors, not in banks. If the bank fails, we have no concern. So we will either, there are many resolution mechanisms. We will amalgamate it with somebody else, sell it to somebody else, pay the depositors, and do whatever is. So there has been no instance wherein we had paid from our deposit insurance for commercial banks, whereas as for small banks, cooperative banks, we have met our obligations very well. And deposit insurance is again insurance. Because you have taken an insurance, can you go for a rash driving? Just because you have taken medical insurance, can you afford to become sick? No. Basically, that you have to manage yourself. And if something goes wrong, we are there to help you. Whether the current liquidity risk measures are strong enough to meet liquidity in all times. Again, CRR and SLR is a last resort. Banks have to manage their own liquidity. And for that, we have given very comprehensive instructions to the bank in 1999, again in 2007, and again very recently, we will be thinking of revising it, wherein we watch the liquidity on day-to-day basis. We watch for the next day, we watch for 3 days, we watch for 1 week, we watch for 1 month, for 6 months, 1 year, 2 years, 3 years. And if we find that there is a gap between this, we take up with the banks and ask them to rectify the position. So, if at all, I'm not talking about the CRR and SLR, they are meant for different purpose. But the banks have to manage their own liquidity, and our present liquidity management, which we do check during every year. And not only that, every month we get the statement from the banks as to what is their liquidity position. And that's how we have been in a position to safeguard the banks. So there can be always a scope for improvement, But as of now, current liquidity risk measures, if the banks follow whatever has been said by Reserve Bank, are fairly good enough. Higher capital adequacy and higher levels of liquidity measures may increase the cost of funds, and bank debt may become costly. Okay, now here we are not talking about the higher capital adequacy. The watchword is economic capital. How much is the risk that you are running, and for that risk, how much is the capital that you require? If you manage your risk well, your capital requirement is less. The benefit goes to the borrower. And ultimately, the bank which manages its risk very well competes in the market very well, and that gets the business. And the bank which is not managing the risk well has higher capital requirement, and it loses in the competition. Is this not a competitive world? Are the banks not supposed to manage their risk? They are supposed to compete on equal footing. So the higher capital, higher liquidity measures, again, we are not talking about the higher liquidity, we talk about the appropriate liquidity. We always talk about the appropriate liquidity. And then it's all about how you manage your short-term liquidity. And there are lots of financial market instruments which are available to the banks wherein they can manage their short-term liquidity. Again, here the watchword is safety, liquidity, and return. Now, if you go for a higher return, you compromise on the liquidity or you compromise on the safety. That means you are not managing your risk very well. And if you don't manage the risk very well, there is no reason why I should protect you. Again, the debt may become, it may discourage the borrowers. If you choose a risky borrower, you are running a risk. And if you choose your borrower, a right borrower, with whatever repayment capacity or income generation that can be generated, if it is for economic activity, and if the economics is worked out properly, there is no such fear. In fact, let me tell you, my banker friends are here. What we find is that we have given clear guidelines as to how to arrive at the interest rate to be charged to the borrower. Very few banks follow it. And when they declare their PLR, what is known as the prime lending rate, and what our observation is, majority of the lending is below PLR. That means either the PLR is wrong, the calculation is wrong, or you are taking undue risk. So I think here the issue is not about whether the borrower will be deterred or not. It is the right pricing that matters. The risk-based pricing, what we have been talking is the pricing should be risk-based. Risk rating is an exercise for deciding the pricing. So I will give another chance to my friends here. I have been too much at the receiving end. So how to improve the transparency?
We have given you enough time, 20 minutes you have been speaking.
But you have given me 10 questions. Underlying risk for the structure.
I gave you the first choice to start, but you conveniently shifted it to Mr. Bhatt. Captured all the points and then started defending, possibly.
No, I'm not defending. I'm just placing the facts before the audience.
Let us see.
Underlying risk of the structured products. Here we have been saying that the transparency and market disclosures are required, and mark to market is something which we have already suggested. The banks are required to disclose in their balance sheet as a notes of account to it, and there is a scope for improvement. In light of this global crisis, we are going to review that. Are risk management norms imposed by regulators become counterproductive in meeting agenda of financial inclusion? Financial inclusion is an agenda which started by us. It is, Reserve Bank is a regulator, is also a development agency. That's why he said whether you are talking regulating or doing this or something like that, that dilemma, is a financial inclusion is our initiative, and for that we have given sufficient relaxation to the banks. It's not that the KYC norms will become impediment in financial inclusion. There are enough, relaxations which are given. If it is for the banks to use them and serve the purpose, rather than say that there is some impediment for this. Okay. And the last, how to improve the accountability of the credit rating agency. Well, this is also a very important topic which is being debated. Credit rating agency is, again, as it is said, it is not because somebody has given this rating, you lend to him. You have to have your own assessment. That's one aspect. Second thing is credit rating agencies, how to evaluate their performance, how to, notify them. There is a process which is followed. Here what we need to say is, in light of the global crisis, what is required to be done is, the conflict of interest is to be handled. Very often the credit rating agencies are also advisors to the borrower, and the borrower pays for the rating, and there is a likelihood of conflict of interest. The governance structure matters, and the governance structure is required to be reviewed in detail in light of the global financial crisis, whereas we have authorized certain agencies, we have never said that you rely on the rating. Okay? So, in a nutshell, I have tried to defend, as our moderator has said, I don't want to fight, I can't fight. So, it is not the question of fighting here, it is a question of putting things in right perspective. Well, the reforms or regulation, I would rather put it reforms in regulation. So the Basel II is something which we have thought as the reforms in regulation. The reforms, as it was put up, when something is deformed, you reform it. When something was going wrong, we have put it on the right track. Now, when things are on the right track, what we need to do is put it on a fast track. So now the question is about putting the things on the fast track. We have got a lot of agenda before us: financial inclusion, growth, economic growth. We have to become, what you said, economic superpower and all that, and that's all the agenda for all of you younger generation here. And I'm very sure that my younger friends here will appreciate whatever steps have been done, taken so far, whatever reforms were introduced so far, and whatever changes are being thought out now in the risk-based regulation of the banks, and probably another 10 years or 15 years from now, some of them will be here to defend Reserve Bank. Thank you very much.
If you leave it to my younger friends here, a dil mange more, they will not be satisfied or they will be appreciating. They'll always be wanting more. From my side, I would add some more things like, the foreign banks are being invited to India in the year 2009. An announcement has been made in the year 2005. If only you analyze foreign banks in India, they are not a threat at all. Hardly they have less than 300 branches. When I have made a study, as big as 45 numbers of foreign banks were there, they have come down to less than 30 now. They are winding up their shops and going. Our public sector banks are definitely robust. My compliments to even my friend here. They have been doing wonderful work thanks to these reforms, thanks to this technology, legal changes and all. So opening up for foreign banks in the year 2009 is not going to really open up a real level playing field for the public, private and foreign banks, because they hardly do any developmental role what Reserve Bank of India will.
Here.
Yes, please.
But it gives us an opportunity that our banks go abroad and earn money.
That's fine. We have maybe about 150, 200 branches, Bank of Baroda, SBI and some other banks put together. But within the country, I can see that our public sector and private sector banks are really doing wonderful work. From 65,000 population per branch in the year 1969, they have brought down by expanding to rural areas and semi-urban areas to bring down 15,000 per branch population, which was a norm given by these banks. So hats off to these public and private sector banks within the country, that foreign banks are not going to be a threat. So we are not going to be alarmed or alerted that foreign banks are going to come in 2009. I don't think this kind of a policy that has really come up has got anything to do. Public sector and private sector banks are doing wonderfully well. I don't know this policy 2009 is going to happen. Similarly, the date for Basel II has been getting shifted from, say, 2007 to 2008, and I don't know what is the current status. Clear picture is not there. In the process, these capital adequacy norms, etc., are being discussed. What revision is going to come, I don't know. I would like to seek his opinions and then some clarification support from my public and private sector bank colleagues. Then DICGC, what you said, the depositor's interest is being protected. This 1 lakh has been archival. How long it has been there, 1 lakh? And the original idea was to protect the small depositor. Today, 1 lakh has tremendously changed. It has not been revised. Credit Guarantee Corporation, the borrowers are also paying the penalty of premium or insurance, so naturally their coverage is taken care separately. Two corporations are merged, Deposit Corporation and Credit Corporation, two corporations are merged. So this 1 lakh has been hanging for so long, why it is not being revised? Another question I would pose is, when New Bank of India, as Mr. Parthasarathy has said we cannot survive, a public sector bank was conveniently merged with Punjab National Bank. There were some problems of culture, HR, of strategy, whatever cases you study. Conveniently, in 1993, it was allowed to merge. Subsequently, three public sector banks, UCO, United, and Indian Bank, they were going red. They have been given a lot of support, whereas banks like Global Trust Bank or Nedungadi Bank or Banaras State Bank or some kind of banks have been asked to liquidate. Why this stepmotherly treatment to private banks vis-a-vis public sector banks? These three public sector banks has been allowed for long, recapitalized. Government of India has given 22,000 crores infusion from the public exchequer, given sufficient time to come back, despite there have been some irregularities. Why this kind of a stepmotherly treatment? Otherwise, why not open it up for a healthy competition? I think I would like something to be added from the participants or from the audience also. Some questions are there. Somebody can take around the mic so that some people can also add value to the discussions rather than only one-sided traffic. Somebody is taking around the mic, please. Please introduce yourself and then raise a question, and whom you are addressing particularly among the three.
Financial inclusion. There's a person who comes to my house to work, and I've asked that person, he gets a very small amount and he works in different houses. So that person is exploited like anything from a big merchant, by a big merchant, because that person is not having a bank account. I don't want to tell the whole story because that will take a lot of time. But so this KYC norms, what you're saying that the banks have been given enough freedom, I don't see that really comes that KYC, I don't see that those freedoms are really being used by banks. I don't know whether it's the fault of RBI or it's the fault of the other banks that they are not using those freedoms which are given in the KYC norms. And so that is why those people who are from the lower strata of the economy, they are being exploited like anything because they are not a part of the banking system. Third is what you said that if you manage, what you have said to the banks, if you manage your risk well, you don't need to, that the cost of debt will not go up. But sir, when it comes to priority lending, don't you force banks to give this much of loans in this particular sector? So sir, don't you ask them, don't you force them to take additional risk by asking them to give this much of loan in the priority sector? And sir,
I have noted now 3 questions you raised.
I think
Are you here? By the way,
there will be some time question for reaction also.
3 questions my friend has raised.
Okay,
One is about the road accident.
Well, road accident and death, well, we have never stopped any innovation from any bank. We have never said any no innovation. No,
please.
Even securitization was allowed. Securitization was not prohibited. Even today also it is not stopped. There what has been said is that after securitization, certain things which, if you are taking securitization, you have to do the due diligence and the risk has to be transferred and there has to be a transparency in the whole mechanism. Even today securitization guidelines provide for it. That is first. And we are on the other hand, we are welcoming innovation, and the question comes as to if the regulation is done beforehand, it stifles the innovation. We are very much aware of that, and therefore our regulatory instructions or this thing come only after certain time, when certain things are noticed. Okay? That takes care of your road accident. Road accident, yeah.
Know your customer.
KYC, yes, KYC has been done. There are two purposes for that. Know your customer to serve him better. That's one aspect. Second thing is, for the type of audience that the customers that you have been telling, the Reserve Bank guidelines, there are enough of liberal distributions available. Now, if the banks are actually taking shelter behind some other circular or other thing, blame the Reserve Bank or blame the bank?
I don't know, you should have shot the questions to these two bankers.
They will take, and now another thing.
Third question.
One more thing.
But, sir.
There is a bank here which has been doing very well in this.
Okay. Possibly you can react on priority sector lending, are you insisting?
Priority sector lending, yes, whatever is there, which is to be done. Priority sector by definition is a priority. We have never said you underprice it. Okay? One thing. And we have never said that you should give X, Y, or Z. You do your assessment, risk assessment. And priority sector is one area wherein, otherwise how do you ensure inclusion? Most of them, we have heard that the farmers are committing suicide and there are lots of social issues which are emerging out of it. Had this not been there, the situation would have been quite grave.